Hi everyone, in this video I'm going to explain to you a new piece of legislation called Section 24 that has completely changed the property investing game. Now, what is Section 24? Well, it was a piece of legislation that was introduced a couple of years ago, and it means that if you purchase a property in your personal name, you're unable to deduct the mortgage as an expense when paying tax. This means that you're paying tax on your gross rental amount minus any kind of maintenance costs. And this has completely changed the property investing game because your mortgage is normally the biggest expense in your property investing business. And if you're unable to claim that as an expense, then you're going to pay significantly more tax. And as soon as this was introduced, it has kind of had a negative impact on property investors that have purchased properties in their personal name. And we've seen so many property investors with 5, 10, 15 different types of properties in their personal name, and they're panicking now because they have to pay significantly more tax to a point where all the profits that they're making can be also negative and loss making. So this has been a really powerful new introduction into the property investing game. Just to explain this further, so let's say you have a property and the rental income is £10,000 per month. So this is how much the tenants are paying you. And then let's say every month you're paying £5,000 in mortgage. Now these are just made up numbers just to keep things quite simple. So you're paying £5,000 in the mortgage. That means your profit is £5,000. £10,000 minus £5,000. So your profit is £5,000. Now, before Section 24 was introduced, if you have a property in your personal name, then you pay tax on this £5,000. But now, following this piece of legislation, you can't use this as an expense, and so you have to pay tax on the £10,000. This is almost twice as much tax that you would pay, which is, significantly going to reduce your profits. With that said, there is a bit of a caveat. So if you purchase properties in a limited company structure, you actually can offset your mortgage as an expense. And so nowadays, people are buying properties in a limited company because of this very reason. There's significantly more tax benefits, and you can expense this massive mortgage that you're paying every month as an expense, and so your profits are significantly higher, or your profits that you pay tax on are significantly higher.